Washington is shifting in a way no one can ignore. It started small, like a ripple barely noticeable, but quickly swelled into a tidal wave crashing through the financial system. There were no explosions or cyber attacks lighting up the news, no dramatic headlines, just a quiet, dangerous upheaval beneath the surface. The pressure has been building under the U.S. economy, invisible to most people, but flashing urgent warnings to anyone watching the bond markets. This crisis didn't begin with armies or weapons. It began with numbers. Treasury yields crept up at first, almost unnoticed, then shot past 4 and 5%. For everyday Americans, those numbers didn't seem important, but inside the global financial world, alarms were ringing non-stop. Investors started pulling back, Treasury auctions were skipped, and what used to be the safest investment in the world became toxic overnight. Fear flooded Wall Street. Phones buzzed endlessly, trading floors throbbed with panic, and rumors spread faster than facts. This was no longer just theory. This was a contagion infecting the system. Washington reacted, but quietly. No grand speeches, no announcements, just a swift reversal. Tariffs on Chinese imports vanished overnight. Electronics, auto parts, industrial machinery, all gone. For an administration that had once stood firm against Beijing, this felt like surrender. Officially, the reason was to fight inflation, but insiders knew better. Days earlier, a Treasury auction had collapsed, foreign demand plunging by nearly 30%, just as the 10-year yield soared toward levels that had crushed regional banks the previous year. Behind closed doors, Treasury Secretary Scott Bessent urgently reached out to Chinese officials, not through public channels, but desperate private calls. Within hours, tariffs disappeared and markets reacted immediately. It wasn't a calculated strategy, it was raw panic. The trouble wasn't just China. In February, Japan, America's closest financial partner, dumped $36.6 billion in U.S. debt, the largest monthly sell-off in over a decade. This wasn't political posturing, it was survival. Japan's central bank ended yield curve controls, forcing institutions to stabilize domestic markets by selling treasuries, the only option left. If Japan was selling, what would Beijing do? By March, China's holdings dropped below $775 billion, a quiet but steep 30% decline from 2018. Beijing didn't need a bold move, just the threat was enough to shake markets. Barclays strategist A.J. Raja warned, "The danger isn't the action itself, it's the expectation." Everyone knows China could weaponize its debt whenever it wants, and Washington would be powerless to respond. This fear peaked on March 27th when the 10-year yield hit 4.96%. The consequences hit hard and fast. Credit markets froze. Mortgage rates skyrocketed past 7.8%. Corporate borrowing costs exploded. Regional bank stocks plunged more than 6% in a single day. The system wasn't just trembling, it was convulsing violently. Goldman Sachs analysts pointed to the root cause: debt service. The national debt had passed $36.2 trillion, and every 1% rise in interest rates added $346 billion in costs annually. The math had become deadly. The Congressional Budget Office quietly updated its forecasts. Interest expenses would soon surpass defense spending. In the first quarter alone, Washington spent $273 billion servicing its debt, more than Medicaid. The financial foundation was cracked. Inside BlackRock, traders were sounding alarms. If yields crossed 5%, the Federal Reserve would have to step in, injecting liquidity to rescue failing banks and save the system, but risking the dollar's credibility. Inflation could roar back, and faith in the U.S. dollar, the bedrock of global finance, could erode irreparably. The tariff rollback wasn't a bold policy shift. It was emergency triage, a desperate attempt to slow the bleeding and buy time. But that time was running out fast. The Fed faced an impossible choice: raise rates to defend the dollar, crush inflation and restore confidence, but choke growth, wreck banks and blow up the federal budget, or pivot, ease policy and flood markets with liquidity, but risk runaway inflation and shatter faith in the dollar. Either way, disaster loomed. The Fed's balance sheet, swollen to $7.44 trillion, was groaning under the strain. In early 2025, it reported a staggering $142 billion loss, the first time in history it paid more interest than it earned. If the crisis worsened, losses would only mount. Meanwhile, Congress bickered over spending caps and debt ceilings, pretending the fire wasn't already raging out of control. Former Treasury official Stephen Ratner summed it up bluntly: triage. The Fed was no longer shaping the future, it was just desperately trying to prevent a total collapse. Survival, not strategy, had become the game. Washington scrambled to stop the bleeding, forced to backstop failing banks and bankroll a government running out of time. But even that might not be enough. The real question now isn't what the Fed will do next. It's whether markets still believe the Fed even matters. Confidence once rock solid is seeping away through cracks no patch can hold. The numbers don't lie. In the first quarter, German government bonds, long considered sleepy, dull, and safe, saw record inflows of $76 billion, a 41% jump year over year. Not because Germany promised better returns, but because investors were fleeing volatility, fleeing the dollar, fleeing a system fracturing in real time. What started as a faint tremor in bond markets has morphed into a direct challenge to U.S. financial dominance. Beijing remains silent, but that silence roars with intent, deliberate, unyielding, and deeply strategic, as more and more actors rush for the exits. Washington's game has morphed, no longer driven by vision or strategic foresight. It's now fueled by fear, by perception, by a frantic scramble to stop the clock before the whole structure crumbles. The once solid center is fracturing. Paralysis has calcified into dysfunction. In Tokyo, policymakers are in full crisis mode, scrambling to defend the yen as if the economy were at war. The old pillars of global order are cracking, fracturing under pressure. While the West stumbles, stutters, and falters, the rest of the world is already pivoting, rewriting the survival manual in real time. The old certainty that U.S. assets are inviolable, sacred, untouchable, is evaporating like mist at dawn. Investors aren't just hedging their bets, they're fleeing. They're not heading to Wall Street, they're running toward Europe. Germany, once dismissed as dull and uninspiring, has transformed into a fortress, the last bastion amid a storm that no longer feels distant or abstract, but immediate and real. The dollar, long the bedrock of global finance, isn't collapsing in a single catastrophic event. It's eroding slowly and relentlessly, like a cliff face being worn away by waves. Since January, the dollar index has slipped nearly 4%, a small number with seismic implications, a glaring fissure in the foundation of global trust. Faith in the dollar is dissolving. Central banks from Brazil to Abu Dhabi are offloading dollars, not out of anger but out of cold calculation, quietly shifting reserves into euros and yen. They do not believe those currencies are flawless. They just no longer believe the dollar's supremacy is a given. This is no mere market correction, it's an exodus. A slow-motion calculated escape from a system propped up by U.S. debt, U.S. dominance, and U.S. financial gravity. A machine now misfiring, its circuits fail. Every day the fuse grows shorter. Every delay, contradiction, and hesitation pushes the global system closer to a precipice it may never climb back from. By March 2025, the share of dollar reserves in global holdings plunged to just above 57%, the lowest level in over 3 decades. What was once a symbol of stability now breeds instability. The dollar, once the anchor of the world economy, is now the eye of the storm. Washington still clings to the helm, but the wheel slips from grasp, maps are obsolete, and passengers are already scanning for lifeboats. Meanwhile, China builds, patiently, relentlessly, ruthlessly, a new financial world that doesn't depend on the dollar at all. The digital yuan is live and spreading. Bilateral trade in local currencies expands rapidly. Energy deals sidestep SWIFT. Infrastructure projects, trade agreements, and settlements are designed explicitly to bypass the US-dominated system. This isn't speculation or distant future talk. It's happening right now, in signed contracts, financed pipelines, deployed code, and it's bleeding into the real economy. Apple didn't fight for exemptions for its iPhone supply chain out of goodwill. Over 60% of its products are still assembled in China. Nearly all of its chip packaging is Chinese. When Tim Cook flew to Beijing in early 2025, it wasn't a photo op, it was a survival mission. His message to Washington was no diplomacy. It was a warning. Full decoupling from China would cost Apple over $21 billion and shatter its strategic roadmap. Decoupling isn't a policy option. It's a cliff over which companies and economies could fall. While corporations bend under pressure, families break. The Federal Reserve reports that 37% of Americans can't cover a $400 emergency without borrowing. Tariffs from past trade wars linger like a shadow, costing households an extra $800 annually. Inflation surged again in 2024, wages shrank, pandemic-era savings have dried up. New tariffs loom, threatening to drive prices on electronics, cars, clothes, even basic necessities up by another 12.4%. Essentials are becoming luxuries. Already, 61% of Americans are cutting back on everything but necessities. The trade war meant to wound Beijing is instead gutting Main Street, with no safety net left to catch the fall. Inside the White House, policy is fractured chaos. Tariffs are imposed and then rolled back. China is condemned publicly but quietly accommodated behind the scenes. Apple is attacked then exempted. A leaked Commerce Department memo confirms what markets have already priced in. A government split in two. One faction demands total separation. The other warns that such separation would trigger collapse. The result? Confusion and disarray reign. Markets see weakness where leadership should be. Trump's approval among independents has crashed to 39%, dragged down by mounting fear, instability, and fragility. The Conference Board's index has plunged for 14 straight months, signaling recession before year's end. Goldman Sachs slashes growth forecasts to a mere 1.2%. Investment is evaporating. Layoffs spread through Wisconsin, Pennsylvania, Michigan, factories hollowed out, profit margins crushed by soaring import costs. The comparisons to 2008 are no longer whispers behind closed doors, they are spoken openly. Yet still no one blinks. The election looms, but markets won't wait. The world won't wait. Interest rate tweaks won't fix this. Targeted tariffs won't fix this. They are bandages slapped on a systemic wound. The real transformation is already underway. China's campaign to dethrone the dollar is no warning shot. It's a construction project. A new financial architecture where Washington's levers no longer move the world. Oil priced in yuan, commodities traded outside Western markets, digital settlements controlled by Beijing. This is not the climax but the prologue. The tariff battles, reserve rotations, and news dramas? They're noise, distraction. The real shift is silent, encoded in contracts, pipelines, and agreements. It's happening now. What lies ahead is not just a financial transition.